Everything you were taught about gold is now wrong. If gold really moves towards $7,000, this is not a rally, it's a verdict, because assets don't behave like this unless the system underneath them is being quietly repriced. That's the contradiction most people miss. Headlines call it a surge. Markets are treating it like a transfer of trust. Here's the fact pattern that matters. Gold didn't just rise in 2025, it exploded up 65%, the strongest annual move in decades. And instead of collapsing after that, it reset. The floor moved higher, well above 3,000. Then, in 2026, prices pushed toward 4,800. Pullback stopped causing fear. Every dip started getting bought. That behavior tells you who is involved. This isn't fast money. This isn't panic hedging. This is slow, deliberate accumulation, the kind that doesn't care about headlines, only outcomes. Now, here's the part nobody says out loud. If gold is being accumulated like this, it's not being bought for protection. It's being bought as a signal against something else you still rely on. And once you understand what that something else is, the number 7,000 stops sounding extreme. What's happening with gold right now didn't start this year, and it didn't start with inflation headlines. It started with something much quieter, a shift in how risk is being priced across developed economies. The official story says this is about growth cycles and market optimism, but the structure underneath tells a different story. Here's the core event without all the noise. Developed nations are carrying debt loads that no one is seriously trying to reduce. That's not a political opinion. That's observable behavior. There is no visible appetite from voters or policymakers to cut spending in a meaningful way. Deficits are treated as permanent. Servicing them requires constant monetary support, and markets know it. This is why gold's move isn't isolated. It's part of a larger pattern where capital quietly exits instruments that depend on fiscal discipline and flows into assets that don't require trust in policy promises. Gold isn't reacting to one crisis, it's reacting to the absence of an exit plan. Now ask yourself the reframing question most people avoid. If debt is permanent and money creation is the solution, what asset benefits the most from that arrangement over time? That question is already being answered in price action. And the next layer makes the shift impossible to ignore. Here's the strong claim that changes how this move should be read. Gold is no longer being treated as a trade. It's being treated as a balance sheet decision. The evidence shows up in who is buying and how they behave. Central banks have been absorbing close to 1,000 tons of gold per year. That's roughly 1/3 of annual global mine supply. Not once, not opportunistically, year after year. That volume alone removes an enormous amount of physical metal from circulation. And unlike retail buyers, central banks don't sell into strength. They lock supply away. This matters because it rewires the market. When that much supply disappears into strategic reserves, price no longer responds the same way. Corrections don't cascade, they stall, then they reverse. That's exactly what we've been seeing. Gold pulls back briefly and demand steps in immediately. Notice what's missing. There's no rush to take profits, no distribution phase, no exhaustion behavior you'd expect after a 65% annual gain. Instead, accumulation continues. This is where the story flips. When price rises without triggering selling, it tells you the buyers are not price sensitive. They're objective driven. And the objective isn't short-term return, it's insulation. Once gold starts functioning like that, traditional valuation logic stops applying. And that sets up the escalation phase that comes next. Once that shift takes hold, the pace changes. What was slow accumulation starts to harden into expectation. And expectation is where markets stop asking if something should happen and start asking when. We've seen this before, but never at this scale. Historically, when sovereign confidence weakens, capital looks for neutrality. In past cycles, that showed up briefly during crises, then faded when policy stabilized. This time, stabilization never arrives. Debt keeps expanding. Monetary support becomes routine. Emergency tools turn permanent. That's the escalation. What should feel abnormal is being normalized. Negative real rates, balance sheet expansion, strategic reserve accumulation, none of this sparks alarm anymore. It's treated as background conditions. But here's why that matters. When abnormal becomes normal, markets stop pricing for resolution and start pricing for duration. Gold isn't moving because of one shock. It's moving because the system has accepted a long-term imbalance. This is where the comparison quietly breaks. In earlier eras, gold spikes were reactions. This one is preemptive. It's being accumulated before the next disruption, not after it. Now watch how fast this escalates. When markets stop believing in reversals, they start pricing endpoints. And that's when targets stop sounding speculative and start sounding mathematical. Here's the second proof point, and it's more uncomfortable. The same institutions publicly defending the stability of the financial system are quietly acting as if that stability won't hold. On one side, official messaging emphasizes confidence, controlled inflation, managed debt, soft landings. On the other side, reserve behavior tells a different story. Gold accumulation doesn't slow when markets calm. It accelerates. That contradiction matters. If decision makers truly believed in long-term currency stability, they wouldn't be converting reserves into an asset with no counterparty risk at this scale. And look at the behavior around interest rates. Even as nominal rates rise, real rates stay compressed or negative once inflation is accounted for. That environment removes the penalty for holding gold. Yet instead of rotating back into yield instruments, strategic buyers keep accumulating metal. Here's the line that permanently reframes this. When the people closest to the system hedge against it, they're not speculating, they're preparing. Notice what isn't happening. There's no coordinated effort to rebuild trust through fiscal restraint, no credible roadmap to reduce sovereign debt burdens, just assurances paired with actions that contradict them. This is why the $7,000 discussion exists at all. It's not about enthusiasm, it's about alignment. Prices move to where incentives point, not where narratives comfort. And once that alignment locks in, the system enters a phase where small shocks start producing outsized reactions. At this stage, pressure stops coming from one direction. It starts stacking. Energy markets enter 2026 with inventories at extreme lows. Crude, gas, diesel, all sitting near decade bottoms. At the same time, institutional exposure is thin. Money managers aren't positioned for a spike. They're neutral, even complacent. That mismatch creates a classic pain trade. If prices move up fast, positioning has to chase. Now layer inflation back into the system. Energy doesn't rise quietly. It bleeds into transport, food, manufacturing. Costs climb, inflation expectations reawaken, and central banks are trapped. Tighten too hard, and debt service breaks. Ease too fast and currencies weaken. That's the second pressure point. Gold benefits from both sides. Inflation pushes investors toward hard assets. Policy hesitation keeps real rates suppressed. The opportunity cost stays low. Then comes the third layer. Higher energy prices raise mining costs. Extraction gets more expensive. Marginal supply backs off. The floor price for metals rises again. This isn't one crisis. It's multiple stresses reinforcing each other, each one manageable alone. Together, they compress the system. What happens if this continues? Now bring this down to where it actually touches you. When currencies weaken slowly, you don't notice it day to day. Your paycheck still arrives. Prices don't jump overnight. But over time, the gap widens between what money says it's worth and what it actually buys. Housing stretches. Insurance creeps higher. Savings stop feeling like security and start feeling like exposure. Gold doesn't rise in isolation from that reality. It rises because more people sense intuitively that storing value inside the system feels riskier than it used to. Not because they read balance sheets, but because their costs keep moving while their purchasing power doesn't. This is why the gold move matters even if you never plan to buy an ounce. It's a signal about confidence. When institutions shift first, households feel the consequences later. Higher prices, tighter credit, fewer safe places to park long-term savings. Notice how this shows up culturally. More conversation about hard assets, more anxiety around cash, more attention to anything described as real. If this feels familiar, say so in the comments. Because when a financial signal reaches everyday behavior, it's no longer theoretical. It's already working its way through the system, and the next layer explains why that transmission keeps accelerating. Here's the mechanism most coverage misses. This isn't driven by panic, it's driven by incentives. Modern financial systems reward leverage, speed, and confidence, but they punish patience and restraint. Governments are incentivized to borrow. Central banks are incentivized to stabilize markets, not reset them. Institutions are incentivized to chase benchmarks, not question the structure underneath them. That combination quietly pushes risk forward in time. Gold sits outside that incentive loop. It doesn't depend on earnings. It doesn't require policy credibility. It doesn't need growth assumptions to hold. That's why it becomes attractive precisely when systems lean harder on belief than constraint. This is why accumulation happens without headlines. It's not emotional, it's procedural. Reserves get diversified, portfolios get adjusted, exposure shifts, one allocation decision at a time. And here's the unsettling insight. The system doesn't need to fail for this to continue. It only needs to remain strained. As long as leverage stays high and resolution stays politically impossible, the incentive to hold neutral assets persists. This is what makes the move durable. Not fear, not excitement, structural pressure, and once markets internalize that pressure, they start looking ahead, not to collapse, but to trajectory, to where this alignment leads if nothing fundamentally changes. From here, the path splits, but neither option looks like a return to the old normal. In one scenario, pressure builds slowly, debt expands, growth underperforms, and policy stays accommodative. Nothing breaks, but nothing heals either. In that environment, gold doesn't spike, it grinds higher. Allocation by allocation, reserve by reserve. The price moves not because of fear, but because it has to clear a market where supply is capped and demand keeps widening. 7,000 becomes less a shock and more a waypoint. In the other scenario, stress arrives faster, an energy shock, a geopolitical escalation, a currency misstep. Something forces markets to reprice risk quickly. When that happens, positioning matters. And right now, many portfolios are still built for stability. That mismatch creates acceleration. Capital moves all at once instead of gradually. Notice the common thread. Neither path requires a crisis narrative. Both rely on momentum that's already in motion. The difference is speed, not direction. This is why timing becomes secondary. The next move isn't waiting for permission. It's forming quietly inside allocation committees and reserve strategies. And once those decisions compound, the final phase isn't announced. It simply shows up in price. Here's the insight that ties all of this together. Gold isn't being priced as a commodity anymore. It's being priced as collateral. Collateral in a world where trust is stretched, debt is permanent, and policy solutions are designed to postpone, not resolve. That's the reclassification most people miss. $7,000 isn't a prediction. It's a translation. It's what a finite asset looks like when measured against systems that expand by necessity. The number itself matters less than what it represents. A shift in what markets quietly consider safe. This story isn't ending with a spike or a crash. It's unfolding through accumulation, normalization, and slow acceptance. By the time it feels obvious, the repricing will already be complete. And this is where the loop stays open. If gold is collateral, not a trade, then other assets will be forced to reprice against it. Energy, silver, currency risk, sovereign debt, that's the next layer. If you want to stay ahead of how this realignment spreads across markets, follow the channel. We'll keep breaking it down before it becomes consensus.